All right, everybody. In this video, we're going to keep working on our Chapter 7 homework problems here, and this is going to be 7.3. And I'm just going to start out by taking the grid lines off, and then I pasted in this copy of the homework problem from the class packet. And we have a little extra reference kind of tool here that's sort of helpful. It says we don't need to complete it, but I think it's a good idea. And let's look through the problem here. And in this problem, just kind of give an overview of what we're going to be doing. We're going to be doing notes receivable type transactions, recording interest revenue, interest receivables, and receipt of the full payment at maturity, etc. So, okay, so here we have three different notes. The first one, we accepted a $10,000 60-day 8% note as an extension of late company's overdue accounts receivable. So what that means is this company was buying stuff from us, had a normal accounts receivable balance, but for whatever reason, they couldn't pay it in time. And so instead they said, okay, we're going to, instead of just having an accounts receivable, we're going to extend them credit essentially and charge them 8% interest. And 60 days, hopefully they pay us in 60 days and we make a little bit of interest revenue on that amount. On January 20th, we loaned $50,000 to borrower company, 50-day 12% note, and then loaned $15,000 to brother company for a 45-day 5% note. Okay, and we're using a 360-day convention, and we're going to record adjusting entries. This is all during January. We're going to record adjusting entries January 31st and February 28th, assuming that February has 28 days, and then record the journal entries at maturity. Okay, so yeah, let's do some of these, fill in some of these boxes up here. So annual interest rate, remember, is just taking your interest rate times the total principal. So if the loans were outstanding a whole year, basically is what we're saying here, you would have earned $800. Just drag that down. So this one you would have earned $6,000. This one we would have earned $750. And then the days in January is going to be, let's see, how I think we can do, let's just figure this out. There might be some ways to do an Excel formula. Yeah, I guess we can do it this way. So we know there's 31 days in January. We assume we entered into this contract on the 15th. So we can take the end of the month, January 31st, minus 15 days that we didn't have this contract in place. So we have 16 days where we're earning interest for this one. This one we can do 31 minus 20. So 11 days this note was earning us interest. And this one we can do 31 minus 24. So minus 15 minus 20 minus 24. How many days outstanding we have the note essentially. We have all of these were fully outstanding the whole time in February. And that because there's 60 days, so this one's only been 44 days. It's going to be paid in March. This one is 50 days, and it's been 39 days at the end of February. So again, I think all these will be paid back in March. This one has 35 days total through February, and it's 45 days. So I'll be repaid on March 10th, for example. Okay. And then we can do January interest by taking the let's do some calculations here. We have to get a daily interest. And so we can take this 800 and divide that by 360. That's our 360-day assumption. We'll do that for each one. And then I'm going to put parentheses around that daily amount. And then we're going to multiply the daily amount by the number of days. So 35.36. And I'm just going to drag it down 183.33 and 14.58. And then I'm going to copy this formula, Control C to copy. Then I'm going to paste this formula into the formula bar there. But instead of doing F4 times January days, I'm going to move that over to be February days. So 28 days, and then drag that down. And then the maturity date, we're going to basically say how many days into March is this going to be before it's paid back. And how we can do that is, so it's 60 days total. So let's take the days that's currently elapsed minus, or let's do that the other way. Take 60 total days minus the days that have already gone by. So this one's going to be on the 16th. Same formula, 50 days minus the days already elapsed to give us the 11th, and then 45 days minus the days in January, February. We have 10 days. So March 16th, 11th, and 10th is the maturity date. And is also how many days we'll have to account for interest revenue to be recorded just in March as we're paid back. Okay, so let's go through now. I'm going to do one thing here. I like 11 for my font, a little smaller. That's fine. And let's start going through. So on the 15th, here we had this note, this initial note, and we have notes receivable. It was $10,000. And we had, in this one, it's kind of different because we didn't just loan the money out necessarily, right? This one was AR that we allowed them to turn into notes receivable. So usually we have cash as an outflow, but in this one, we are changing their AR into a receivable instead. So it's a little different than the norm. And we'll say late co 60 day 8%. And we'll do italics. So that's our first note. And then the other two are more common, more normal, I guess, if you want to think of how we usually look at extending notes and loaning money, because now we're actually loaning money. In the first one, we weren't really loaning money. We're just allowing them to change their account receivable into a note. They owed us money, and we're just changing that basically. So 50 day 12% for this one. So that looks, wait, was it 50? Yeah, that looks good. Okay. And then on the 24th, that Q there. On the 24th, similar thing. This was 15,000. We could have linked up to the principal. That would have been the same. But this one's going to be Brother Co. This one's 45 day at 5%. So we're just loaning money out all over the place. I guess we're a lender company. We're a bank or something, essentially. And that's kind of the function that we're doing there. Okay, so now we're going to want to look at, that's our initial transactions. We want to record adjusting entries at the end of January for each of these notes. And we're going to want to record our interest receivable. So on January 31st, we have interest receivable, and then we have interest revenue as our credit. So we earned revenue during the month of January. And we already calculated that, so that is helpful to have, right? So we just add all three of those together, and that's the amount for all those notes that we earned and we're owed, the $233.47. And then I'm just going to copy this, or let's put an explanation in. We'll say accrue January interest income. Boop, make that italics. Okay. This one, we're going to accrue February interest income. So similar deal, we're just going to add all these together. So that's the February amount of interest earned. And we're going to do that one on 2/28. Okay. And then now we're going to record our transactions, and we're going to do them chronologically. So the first one, by date, is going to be the this outstanding note's going to be paid back first. So on 3/10, we're going to get cash, and then we're going to have a reduction, a payback of this interest receivable. The note receivable is going to go away. That's the principal being paid back. And then a portion of interest revenue for the 10 days that the note was outstanding in March. You know, the interest revenue we hadn't yet recorded for these 10 days. Okay, let's format our journal entry there. And so the note receivable amount that we're getting back is this brother company. We're going to get $15,000 of principal, returned to us. Our interest receivable piece that we've already recorded for the brother note is this 1458 plus the January and February. Those are all grouped up, in these journal entries that we just summarized. But that's the specific portion applicable to brother company. And then the interest revenue for March is going to be, let's see here. So let's do annual interest. I'll do this with a parentheses. So annual interest divided by 360 times the number of days in March, which is basically what we did up in these form. We should have probably made a column for March, but that's okay. So that's all three of those. Let's add them together and notice that brother company is going to pay us back $15,093.75. And that's, for allowing them to borrow that money for 45 days. Okay, and then let's copy and use that use the same kind of overall format for the next receipt, and that will be borrower company. Here is the second one, paid back on the 11th. And our interest receivable portion will be, again, these two pieces here, January and February. The overall note receivable is $50,000 being paid back to us. And then let's copy this formula, or actually it's already kind of in there. Let's just move some of this back up here. So we want 11. Let's see, let me make sure this is working right. I'm going to copy the original formula and then paste it into the formula bar. And then we can see up here, this was related to that one. So we want to move this up to borrower company. And then this formula just adds all three of those. So they're paying us back $50,833.33. And we had originally just loaned them $50,000. So we're making money. Luckily, everyone's paying us back. That's good. The last one's paid on the 16th. That's the biggest thing when you're a lender, is that you don't want to loan money to individuals that never pay you back. So that is important. This one's Late Co. And Late Co, so that's the same formula kind of carried down there. The interest receivable portion for Late Co was the 2 months there. The note receivable is the principal of $10,000. So we got our $10,000 finally from that accounts receivable we originally sold, or whatever we did, service or something for them. And then finally, interest revenue. Again, I'm going to copy the formula out of the formula bar and paste it back into the formula bar so it maintains that same cells that we did for the one above it. And then it's more clear what we need to do. We just need to move those both up to a different spot. Gives us $35.56, and so the total sum payback is $10,133.33. Yeah, I think that's everything. So having this table is really nice, for us to be able to figure out the days, because that is kind of a little bit of a hassle sometimes when you're doing like the exercises of Googling, how many days between these two dates. So really just getting those locked in a spreadsheet makes it a lot easier to calculate interest out for different types of problems like these. So, all right, thanks everybody. In the next video, we'll finish up the chapter 7 homework with the next tab here, 7.